Good morning, everybody. Welcome to this webinar update about South Africa's poor diplomatic choices and global recessionary fears that's still looming around. With us, as always, is George Glenos from ETM. Going to do the presentation. And joining us also Quentin from ETM and Andre Celia, currency strategist at TreasuryONE. So George, we've seen being in the month of May, the rand was the second worst performing currency on an expanded major basis based on Bloomberg. Only Argentinian peso marginally underperformed more than the rand. And then you take that world currency rank and you change it to June, from the 1st of June till where we are today. And then right at the top of the best performing currency in the world by quite a margin again is the rand. So from underperformance to overperformance, and now we're sort of almost back into that 1750, 1850 range that we've been trading, that we traded since February until the middle of May before we had this blowout. So it's interesting. We've just chatted a little bit off air about what happens. George just alluded to a comment. I'll sure it popped out on Bloomberg this morning. I'll sure he will allude to it. But I'm not going to talk too much because I think about 2 weeks ago, everybody was negative and everybody was talking the rand can only go one way. We're going to see 20 or 20, and then next 21. And all of a sudden, we're back at 1850. Still we're undervalued at these current levels. We're still not out of the woods. But at least it feels a lot better than it felt when we were up at 1990 just a little while ago. So, George, I'm going to hand over to you to have a chat. And as always, on the right-hand side, there's space for questions. So please feel free to ask your questions over there. We'll attend to that as soon as possible, even during the presentation, or chop George if you have an interesting question. But over to you, George.
Perfect. Thank you, Vichard. Morning, everybody. It's amazing what a couple of weeks can make in terms of difference in the financial markets. 2-3 weeks ago, we were all hitting the depths of depression, and at the moment, we're waking up with a smile every morning, admiring this currency that just keeps going stronger and stronger. And it's quite difficult to kind of make head or tail out of how this thing does what it does. And it's got the moniker, it's got the title of being the rattler for a reason, because just as Vichard was alluding to, just when we thought we were going to start hitting the 20s, this thing turned around and jumped in the other direction, and it's moved quite significantly over the past week and a half. So we're thankful for that. But I think there's a backstory to all of this, and the backstory, as per usual, is one where this government and its choices does not make life easy for the average South African business that has quite a lot of uncertainty and a lot of noise to navigate on a daily basis, such that it can make profitability, well, it certainly erodes profitability, and it makes strategic planning that much more difficult. So, when Vichard alluded to what we should talk about, and obviously the one point that we had to cover was, of course, this decision by the South African government to hold this non-aligned position with Russia, and then we hear these reports or revelations that there were arms that were loaded onto the Lady R in Simonstown, and then you hear about them wanting to announce Vladimir Putin as being part of the BRICS Summit and actually going to attend in person, despite the fact that the International Criminal Court has issued a warrant of arrest for him, which South Africa doesn't obviously want to participate in. Yet we're a signatory to the whole thing, and so bound by their rules and regulations as well. Not that it did much with Omar al-Bashir. We seem to ignore that one too. But that was a different regime, and one thought and one hoped that we had somebody a little more responsible at the helm at the moment. But it seems to be that the more things change, the more they stay the same. And the ANC remains a party that has its own ideologies that can sometimes be quite different to that of the rest of the country, certainly different to that of business in South Africa. So I thought about how I would go around trying to get some sense of what this political climate is doing for South African business. And I went digging around for something that might be of use that would paint a particular picture. And I found a very interesting set of data produced by the Bureau of Economic Research. It's housed within their manufacturing confidence data, and specifically, there is an index that's generated out of a survey that they conduct, which specifically looks at the constraints on current activities of the general political climate of the day. Now, what you want is you want to see this blue line heading down. And during the days of Thabo Mbeki, when we had Trevor Manuel as finance minister, when the country was running a budget surplus, we seemed to be in the heyday of South Africa at the time. We were really starting to hit our straps insofar as the rejuvenation of South Africa into the global economy was concerned. The Nelson Mandela feel-good factor was still very strong at that point. And so you can see that the constraints on current activities of the general political climate fell very sharply to levels of under 30 on this index. Now, under 30 on this index is actually pretty low. It's historically low. So we've moved from a position of being historically low back in 2004 to one of being historically high just in the past quarter. And I think this is why I wanted to highlight this chart. It's, of course, the trend, which is a dangerous one, where we've gone from where we were in 2004 all the way through to where we landed up in 2020, just before the onset of the of the pandemic. But then through the pandemic, the constraints didn't really rise. It only ticked up very, very strongly towards the back end of last year and the beginning of this year, which is quite telling, because if we've managed to navigate COVID without this constraint on current activities ticking higher, and in fact, if anything, showing signs of rolling over as the Ramaphosa administration looked to try and stabilize the economy, it comes like a real slap in the face to see this latest spike up in this index. So it means that now business perceives the general political climate as being a major constraint on current activities. And who can blame them? Between load shedding, which has become now a permanent feature of the South African economy, you've had the grey listing, which has come along at the same time, all against the backdrop of having lost our investment grade rating. The constant bailing out of Eskom, which has been enormous, and we've had to roll that debt up onto the public balance sheet such that taxpayers are now funding for that, across through to the likes of Transnet that are also failing and not performing particularly well. So the constraints on current activities have caught up to the ANC. The general political climate that they've created has been one which is not only very fractious, but fractious domestically as well as internationally. So we've had a situation where your foreigners are now looking at South Africa and saying, hang on a second, guys, what on earth is it that you are doing? This is a break from where things were. And in fact, it wasn't long ago, it was about a week ago, that I had a very concerned phone call from a fund management client of ours who approached me to do a study for him on other countries that had experienced a very sharp change in the political dispensation. In other words, that within a particular political party, there had been a fairly substantial shift in that party towards more populist positions, and how that unfolded for their economies. And they came up specifically with two examples. They wanted me to look at Turkey, they wanted me to look at Argentina, and they've asked me to look at any other countries that might fit the bill. The bottom line is that they wanted to understand what happens when a country decides to go down the route of a more populist policy, and how it is that the external world engages with those policies and with that government. And of course, the answer to that is not particularly good. So at the same time, we saw that very sharp jump up in the constraints to business activity of the political environment at the time. It should come as no surprise that the rand, which is reflected in the black line over here, was, as of 2 weeks ago, one of the worst performing emerging market currencies. Now, to give you a sense of that relative performance, I've indexated all of these currencies to the beginning of the year so that you can see just how badly the rand has underperformed. More recently, it's popped back up, and the Turkish lira has crashed back down, and the Russian ruble is not doing particularly well. And at the same time, the rand has recovered more recently. So now we're the third worst. And as Vichard pointed out, if I indexated this to the beginning of June, you'd probably find South Africa being one of the best performing currencies. But it doesn't detract from where we've come from. And so we're still quite a long way behind where we started the year. There's a long way to go before we get even close to the middle rankings of this particular study. So you can see very clearly that there's been an unbelievable erosion of value in the currency, and that has largely been a function of the way that the news flow and the optics towards South Africa have unfolded since the beginning of the year. Making matters a little bit more tricky for South Africa is the fact that amongst emerging markets, we haven't been the most aggressive in lifting interest rates. So here again, I thought it would be good to do a comparison with other emerging markets to show you just how much more aggressive other emerging markets have been. So South Africa is the dark black line. You can see, yes, we have started increasing interest rates before the Fed did, and we did do so fairly steadily and consistently throughout 2022 and into 2023. But have a look at what other central banks have done. Have a look at what the likes of Colombia and Brazil and others have done. They have done substantially more. Latin American countries as a whole have been far more aggressive in their monetary tightening. They've been far more conservative in the way that they've managed their funds. And so South Africa, by this measure, does not stand out as a country that has done a substantial amount of work to try and not just keep pace with other emerging markets that are hiking, but to try and dissuade that negative speculation against the rand by raising interest rates to a point where it becomes quite punitive.
George, I want to quickly stop you here.
George,
yeah.
Good morning. Whilst you're speaking about this interest rates and the way ours was increased and not standing out, can you just allude to our inflation between these countries that we're speaking about here? Also what the inflation rates look like so that one can get a sense of what the real interest rates are and how that changed over time.
Yeah, it's a pity I don't have those inflation rates in here. South Africa was round about middle pegging, not the highest of the inflation episodes, not by any stretch. But even if I'd looked at this on a real interest rate basis, South African interest rates wouldn't have stood out as being unbelievably good. They were higher than what they reflect on this particular chart, but certainly not near the top. By comparison, you had countries like Mexico, for example, that were far more aggressive in their monetary tightening. Of course, you had the opposite too, where you had the likes of Turkey that went and reduced interest rates over time, and that has not stood them in good stead. If you remember the previous chart, Turkey, in reducing interest rates, encouraged speculation against the Turkish lira, which has been by far one of the worst performing currencies more recently. So it does matter. Unfortunately, South Africa still doesn't rank right up at the top insofar as real interest rates are concerned. And at the moment, we've got a peculiar situation where whereas we were one of the countries where inflation appeared to be more or less contained, we've now got a situation where inflation is in fact remaining stubbornly high, much higher than would have been anticipated. Part of the reason for that has been the underperformance of the rand. So it's caught up to us a little bit. And now we're sitting with a situation where we're not focused on inflation coming back as sharply as we were, let's say, at the beginning of the year. At the beginning of the year, we were anticipating inflation would be closer to around the 6% mark, around about now, and possibly even dipping below the upper limit of the inflation target range. That doesn't seem to be the case anymore. In fact, we'll probably find inflation being on a more gradual downward trend, which means that South Africa is going to have to nudge interest rates up a little bit more and then keep them more elevated for longer. Andre, you satisfied with that answer?
Yes, thank you, George.
Okay, perfect. Right, so moving on, whilst one could argue that the Reserve Bank could have done a little bit more to jack up interest rates, the one thing that we have noticed is that portfolio flows have played a very important role in determining the general behavior and performance of the rand. Specifically, look at the right-hand chart. The left-hand chart combines both bonds and equities. That would be the black line on the left-hand chart. The right-hand chart, we split them out. And we split them out for a reason, because you'll notice that the red line, which is the dollar rand, sits very closely on top of the black line, which is your South African government bonds and the performance of your South African government bonds. And quite clearly, the movement in the bond market has been a very important determinant of the performance of the rand. Now, you may ask, why has South African bonds not performed particularly well? Well, part of the reason is that risk adjusted, they simply haven't offered enough of a discount, or rather high enough yields to entice foreigners back into SA bonds. In fact, if one has a look at foreign ownership of South African bonds as a percentage of the total amount of bonds issued, you'll notice that South Africa, which is and I ask you to focus on the black section at this point, back in 2018, whilst we were still investment grade, foreigners owned approximately 42% of the bonds South Africa had in issue. We've now dropped all the way down to 25%. So that is a fairly significant moderation as a percentage of the total. In nominal terms, it doesn't mean that they've sold off very aggressively. They've kind of like held more or less the levels that they were at, and in fact trimmed them slightly. But it's as a proportion of the overall that's important. And as a proportion of the overall, there's certainly been a dilution of the interest that foreigners have paid in the South African bond market.
George,
looking at
George, I quickly interrupt you on that chart. If you go back at the financial stability review that the Reserve Bank governor did about 2 weeks ago, he also alluded to that, and he said the Reserve Bank's becoming worrisome about how much domestic exposure local banks and fund managers have towards government at this stage. Is that something of a concern? The concern that he raised is also something that we need to look at as a concern, that foreigners is not buying our bonds, and all the local banks and asset managers and all of that's picking up that yield, which is great yield at the moment for taking South African government risk, but isn't the concentration risk becoming too big, a little bit too big? He raised it as a concern. So
yeah, and Vikard, I think he's right to raise it as a concern. It is a concentration risk, and it does mean that South Africa is becoming more and more dependent on the performance of the South African government, which, as we know, has not been particularly good. So if your fiscal position of a country is deteriorating and you're forcing your banks to have to absorb more and more of that government debt just to keep the government funded, then you know that you are building up a liability at the bank level that will need to be satisfied. In other words, if the government at some point in the future starts to become delinquent, the risk, and this is why the Reserve Bank would be worried about it, the risk is that some of that rolls down onto the bank balance sheets. And if the bank balance sheets start to get eroded, it undermines the credit cycle of the South African economy, and it undermines the stability of the banking system overall. So essentially what the Reserve Bank is saying is that we would prefer to see the holdings of South African bonds being more diversified, not just domestically, but internationally as well. But of course, if you're going to constantly run your government badly and you're going to impose more and more risk on those people that are holding those government bonds, naturally, what you're going to find is that they're going to demand higher and higher yields. In other words, they're going to demand something in return to compensate them for the higher risk that they take, except that it becomes a vicious cycle. The higher the interest that they are prepared to accept in order to part with their money and lend that money to government, the higher the interest bill that government has to pay, the worse their financial position becomes. And so you see the spiral can easily get out of hand. At the moment, South Africa's debt position is one of steadily rising, and it's an unsustainable trajectory right now. So the Reserve Bank is correct to be concerned about this. It is reflected in this particular chart as to why they are concerned. You're starting to see foreigners just shying away from South African bonds, saying, we've got our fill. We're not prepared to buy more until the South African government starts to behave in a more responsible fashion. Now, them choosing to cozy up to Russia, against which we have very little meaningful trade, is just not a particularly useful thing to do. On top of the bailing out of Eskom, on top of the dysfunctional municipalities, which are owed something in the order of about 300 billion. They're experiencing cash flow liquidity problems. So this government and National Treasury have a lot of unfunded liabilities sitting off the balance sheets that aren't even reflected in the government finance stats, that at some point are going to need to be funded by taxpayers. And then you begin to realize that the burden on the state is far greater than it reflects in the numbers outright. And that would go a long way to explaining why foreigners would want to just make sure that they don't overexpose their portfolios to South Africa because of the risk that this government provides. And it's because of that risk that South Africa becomes more and more vulnerable to episodes of bad news. You mentioned earlier today that I told you about some interesting news that had been received overnight that was published on Bloomberg this morning, where the US Congress is now urging the White House to take a stronger stance against South Africa and their relationship with Russia. They are far from convinced that South Africa didn't load some sort of armaments onto the Lady R, and they do not appreciate South Africa's cozying up to Russia through the course of this Russian-Ukrainian war. The Americans perceive it to be a threat to their national security. And of course, they're looking to place some emphasis on AGOA. There's about $3 billion worth of annual trade that takes place there, which they're saying, well, why should South Africa keep benefiting from this trade deal if they're going to undermine our international geopolitical efforts on another front? That doesn't sound like an ally to us, and as such, we would like the White House to take a stronger stance. Now, that news happened overnight. I don't think it's in the markets yet, but it could very well be the kind of news that puts the brakes on how much further the rand strengthens, unfortunately. And there again, if it does start to weaken today, you'll have another perfect example of how bad political choices can translate directly into rand volatility, which is not helpful for South African business or South African households. So moving on, South African bond yields have had to remain a little more elevated than they otherwise would need to for a country with an inflation rate the size of ours. Our inflation rate is not particularly high. So we're talking about real yields here of around 5% odd. In some cases, a little bit more, depending on how far out the curve you go. Ordinarily, that would be a screaming buy, but as I've just shown you, foreigners have shied away from South African bonds, and so it has left the rand a little more vulnerable. Obviously, the big elephant in the room remains Eskom at this stage. You can see Eskom's electricity available for distribution being the blue line in the left-hand chart that's been cruising steadily lower. Thankfully, the red line, which is total electricity production in South Africa, has not cruised as low and not dropping as sharply. And that's made up by the difference, which is reflected in the bottom half of this chart, which is effectively the private sector's contribution towards electricity generation. So as Eskom is failing to produce that electricity, so the private sector seems to be taking up the slack. But it's the chart on the right really that speaks volumes about South Africa's position right now and why it is so sensitive to the politics of the day, as well as any bad news that comes along. Is that as a country, and as a country that we would desperately want to grow, what you don't want to see is electricity intensity as a percent of GDP dropping. Now, you would like to see this chart going sideways at a base minimum, or in fact increasing. Increasing would speak to your fourth industrial revolution and the electrification of the country and greater productivity and improved efficiencies, etc. We're seeing the exact opposite here. So that in itself is massively problematic and part of the risk, element that needs to be priced into South African markets. But it hasn't just been about Eskom. Eskom is just one of the underperformers. And of course, load shedding, you can see the impact that load shedding has had on the South African growth trajectory. Whereas we used to move in lockstep with global GDP. And in fact, in the period from around about 03 to 07, the red line was in fact moving higher at a faster rate than global GDP. That was the heyday of South Africa, like I said. We then managed to move in lockstep for a few more years after that before load shedding and state capture really started to take hold. And you can see all of a sudden South Africa's growth trajectory just deviated significantly from the rest of the world. It's no longer investment grade. We've been grey listed. We've got underperforming state-owned enterprises, bailout after bailout. A government that just doesn't seem to be capable of turning the ship around. So the net result is that we now have an economy that is underperforming. Much of that is very much a function of the political choices that have been made, and that just don't seem to be ending. The longer we continue with our friendship with the likes of Russia, the more difficult it becomes for all parties concerned. So as I move on to the international environment, just to give you a sense, that gives you a local flavor of what's been happening. Internationally, though, we are starting to see signs that things are tightening up, that the business cycle is changing, and that has got some interesting implications for South Africa longer term. So let's just go through some of those quickly. Well, we know that in March we had a US banking crisis of sorts. We know that aggregate conditions, as produced by the FDIC, which you see in this data, has now dipped to negative for the first time since the global financial crisis, and you'd have to go all the way back to the recessions of the early 90s in America to replicate that. So this is a significant event, and it has tightened up banking conditions. And it's done so because, well, through the course of time, we know that general leverage ratios across US banks have risen. And that's despite all the regulation that's being imposed. So despite all of that fresh regulation, banks still went chasing after ways of making more money. And the only way that they could really extract more money out of a low interest rate environment was by applying higher degrees of leverage. But those higher degrees of leverage obviously render you a little more vulnerable. Interestingly, the bulk of that higher leverage was concentrated in the smaller banks, and it was the smaller banks that were the ones that hit the wall in March and are under a tremendous amount of stress. And to just give you some perspective as to how big the losses that were sustained in March were, have a look at this chart, because you go back to the financial crisis of 08, 09, and the losses that were going to crater the banks back then. And you compare those losses to where we are now, and you begin to realize just how much bigger this was as a problem compared to 08, 09, which is quite staggering when you consider that it was the smaller tier banks that were in trouble this time around. And if you consider all the stress that came through the financial system back in 08, 09, compared to now. So with the benefit of hindsight, the central banks knew exactly what to do. They liquefied the market very quickly. They stabilized the markets. They wrote off shareholders. They focused on mergers of these smaller banks into bigger, more sustainable banks that had very strong balance sheets. And so we got over this really, really quickly. But it doesn't change the fact that there's been a significant tightening in liquidity positions. We see that dollar liquidity tightening up in this particular chart, and we tend to think of this as a tidal chart. As the tide comes in, it floats all markets, and you tend to find these boom times and these periods of excess positivity tend to come through. You'll see the labels up at the top of this chart are all the good times. The exact opposite applies at the bottom of this chart. It's when all the crises, the shocks, the subprimes, debt crises, global financial crisis, all of that happened when the liquidity got drained back out of the system. Well, unfortunately, what I can report is that liquidity conditions are drying up fairly substantially, and that's very much a function of the interest rates that have been jacked up, not just by the Fed, but by other major central banks. Also, the fact that they are withdrawing liquidity from their own balance sheets and doing so fairly aggressively. For now, GDP in the US seems to be holding up and doing okay, but it's off a lower base now. We are through the COVID period distortions, and now we're more normalized. But we're off this lower base. We're now starting to face quite significant headwinds. The amount of monetary tightening that has been imposed on the global economy has been unprecedented. That gets reflected very neatly in the chart on the left. You can see it goes all the way back to the 1940s, and never before have we had a period where so many central banks have raised interest rates by such large amounts in such a coordinated fashion. So never before have we seen that. That is quite unprecedented. The chart on the right is just a zoomed in version of the chart on the left. Fortunately, it looks like we're at the tail end of that hiking. So you can see that's peaked and rolling back over again. And very soon we think we're going to be staring at an environment of rate cuts. But it's not without having experienced some fairly significant impacts to the liquidity positions, as I've indicated. Quantitative tightening is a policy that the Fed is adopting at the moment, and which is draining the Fed's balance sheet and draining it quite aggressively. It's got a long way to go. Through COVID, the Fed printed up some $5 trillion. We've barely removed about 700-800 million of that, billion of that. So there's a long way to go. Many more years of draining liquidity at this rate, and I'm not sure that the global economy can withstand that. But the chart on the right is a zoomed-in version of what you see on the left, and you can see that there is a steady reduction of balance sheets that is taking place at the Fed. It's not just the Fed, though. Other central banks around the world are draining liquidity as well. So you've got all your major central banks, not just lifting interest rates, but removing liquidity out of the system, which naturally is going to play a role in turning the overall interest rate cycle. So the way that the market sees interest rates at the moment, focus on the chart on the left, is that the Fed is pretty close to peaking. It may have another 25 basis points to go in terms of hikes, but after that, they're anticipating rate cuts. The ECB is not far behind. It's just the Bank of England that has a little bit more work to do, which is not surprising given that they've got the highest inflation out of those three jurisdictions. So your major central banks are nearing the peak in their interest rate hike cycle, but there is still more work to do. And at the very least, they're going to be keeping interest rates at these sorts of levels for a period of another 6 to 9 months. Excuse me. Right, we've had all of this tightening has translated into US money supply contracting. That's the blue line. It will drag inflation lower. And today, we will get another update on US inflation, and we expect that US inflation to drop closer to around about the 4% mark. So that red line is continuing to drop. it makes life interesting for the Federal Reserve, because there are going to be questions asked as to why the Federal Reserve needs to continue hiking interest rates when inflation is in fact dropping, and dropping quite sharply back towards its target of around 2%. It's got a ways to go, but it's now firmly on the way there. And at the very least, it's easing the pressure on the Federal Reserve and how much more it needs to tighten. But confidence levels of CEOs is still pretty weak. And we know that from the CEO Conference Board CEO Confidence Index, which is the blue line. The red line is simply your forward earnings per share. So the forward earnings per share likely to remain under a little bit of pressure. Now, you may look at all of this and say, yes, but George, Wall Street just keeps powering from record to record. And you would be right. But I recall that you've had a period where you've had some $5 trillion that were pumped in, only 700-800 billion pulled back out in America. So you've still got a good few trillion of spare capacity in the system still. It's still finding expression in these asset prices. But that doesn't mean to say that just because those very specific financial market asset prices are going up, that it gets reflected in the real economy. In fact, in the real economy, we're starting to see very real signs of change. So when you have a look at your 30-year mortgage rate, which is the blue line, that's sitting at multi-year highs, and you contrast that with the purchasing index, which is the red line, which is effectively demand for property, and you see that is the lowest levels that it's been in over 2 decades. So it has come under significant pressure. But more importantly, have a look at the bottom bit of this chart, and you'll see that your house prices are about to turn negative, just as they did during the financial crisis. Now, that's important because what does it do? Well, it places a constraint on bank balance sheets, and bank balance sheets, as they start to come under significant pressure, so banks tighten up on their credit lending. And as they tighten up on their credit lending, the business cycle turns and rolls over. We have got very clear signals, and here's updates on the shape of the yield curves. The yield curves right now remain very inverted. They're still pointing to the fact that interest rates in America have risen quite significantly and are going to place a constraint on the business cycle. We do know that such levels of inversion historically have led to recessions. So we think that this time around, the same will apply. We just have to be a little more patient whilst all this excess liquidity continues to be withdrawn out of the system. So just be patient. It's not that the system isn't working like it used to. It just means that there's a lot of liquidity that still needs to be drained back out of the system. So your developed market bond yields are likely to drop, and that's important because if we believe that we're at the peak, and investors tend to look through the cycle at the fact that central banks are not going to be hiking much more, and in fact reducing interest rates in the future alongside a reduction in inflation, which is reflected in this very next chart, then you begin to realize that in fact it's an environment where your emerging markets that are likely to hold their interest rates higher for longer versus your developed markets that are likely to experience a reduction in interest rates, all of a sudden the scales turn back to in favor of emerging market currencies performing a little bit better. It also could happen that the dollar, which remains in very, very heavily overbought territory, needs to correct weaker. We're still off that movie. So far, we've been proven reasonably correct. We've moved from a position of gross overvaluation of in excess of 20% down to around about 15% overvalued. We still think more of that overvaluation can unwind through the course of the next year or so. And as it does, it'll ease the pressure on emerging markets, including the rand. In the US's case in particular, we know that there's a lot of focus on what's happening in the jobs market and the fact that it remains very resilient. Well, it's not as resilient as it was. Here too, We're starting to see early signs that the jobs market in the US is losing a little bit of its luster. It's not as robust as it was. And in fact, the weekly jobs data is now starting to come off more regularly as a trend. And we think that that will continue to drop to more normalized levels of around 6-7 million. If it does so, it means that there's quite a lot of slack that comes back into the labor market. And as we are operating very close to full employment, which is the red line, the marginal benefit of accumulating more jobs now starts to drop off. And as it does, the US economy loses some of its momentum. And as you can see, I don't think we're far off a period where unemployment rate is going to jump quite sharply. It always comes down to what the ultimate catalyst is going to be. Back in 2020, of course, it was COVID. So you saw that very sharp rise in unemployment back then. Prior to that, it was the global financial crisis. Prior to that, it was Greenspan's irrational exuberance and all of that. So you do go through phases. I don't know exactly what the catalyst for the next spike in unemployment in the US is going to be, but something will surely come along. We do know that there's enough debt in the system to trigger something of that nature. Shifting across to South Africa, that leaves our business cycle a little bit challenged. So, on the higher frequency blue line and the short-term leading indicator that we've created, we're in challenging economic times. Well, that shouldn't come as much of a surprise. The longer-term black line is also in those same challenging times. So again, speaks to the political decision-making of this government and the fact that their choices haven't been good and their maladministration has eventually caught up to them. The South African economy is indeed struggling, and that's before we've entered any major global recession. So difficulties there. Fortunately for us, South Africa's terms of trade have held up reasonably well. That's the chart on the left. And so that has assisted in helping the rand recover from where it was, one of the worst performing currencies in the world. It's now, in the lower part of the table for sure, but gradually climbing back up to mid-table, which is a far more comfortable place to be. So our terms of trade have improved. If one has a look at the current account data that was released earlier this month, the current account data improved as well, beat expectations. Part of that is very much a function of less repatriation of domestic dividends and coupon payments, just because South Africa is not doing particularly well. So that was part and parcel of that. But we've also had a trade account that has remained in surplus. We fully anticipate that current account is going to move back into surplus over the next couple of quarters. South Africa's current account tends to move into surplus during periods of economic difficulty, and we are expecting South Africa to go through this phase of economic difficulty in the second half of this year as the global business cycle turns and as the full effects of load shedding continue to weigh on the performance of the South African economy. That being said, I must say it's been quite fascinating to see how load shedding has just suddenly eased up quite significantly. And I don't think it's just pure coincidence that the rand has made a recovery off its lows whilst this period of load shedding has eased a little bit. But to put it in context, I mean, we've had a recovery in the rand, absolutely. But you can see that we've recovered, and you can barely see that evident on the over-undervaluation of our exchange rate. So we've moved from a position of being negative 22% undervalued to being, negative 17% undervalued. Okay, fine. That means we've made back 5%. But in the broader scheme of things, we've got a long way to go before we can get ourselves back to anything approaching neutral level. So there's more work for the rand there to do against on a real effective exchange rate basis. That's the chart on the right. Again, similar picture unfolds. Against the euro, barely perceptible the fact that we've recovered off the lows against the euro. We're still sitting more or less 30% undervalued against the likes of the euro, and about 13% undervalued against the pound. Again, you look at the move that we've seen in the rand over the past 2 weeks, and you think to yourself, wow, that's a huge move. We've moved over a rand to the dollar, the pound, the euro, all of these kind of things. You think to yourself, oh, thank goodness. But when you pull back the lens and you look at it in context, you realize, hang on a second, we've got a long, long way to go before we're back to more normalized type levels. Inflation in South Africa is something that we pay attention to because it forms a fundamental backdrop to any currency. It would be inconsistent to see an inflation rate spiking like it is in Turkey and be witnessing inflation coming down. The two tend to work more or less together. Why? Because they both reflect the purchasing power of a currency. So we want to see South Africa, any indications that South African inflation is going to come back down again, and that's reflected in the blue line in the left-hand chart. It's below zero. It means that we're in disinflation territory. It means that there is some price stability that's coming back into the system. And that is generally fundamentally good news for the South African rand. The chart on the right just puts it a little bit in perspective and goes back to the question of Andre on what does South Africa's inflation look like. Well, in context, you've got South Africa's inflation versus US inflation, US inflation being the red line, South African inflation being the blue. We do expect both to moderate, but of course the red line to moderate a little bit more sharply than the blue. So the repo rate domestically still has a little bit further to rise. How much further? Well, 2 weeks ago, we were pricing in another 50 basis point hike, plus another 2 25 basis point hikes after that. So another full 100 basis points higher from where we were. That has since moderated. We're now back down to a 25 basis points hike at the next meeting, at least one more 25 basis point hike thereafter, and maybe a third 25 basis points after that. However it turns out, much of it is going to be dependent on what happens to the rand. The rand at this point in time is staging a recovery, but let's see whether or not it is sustained. Unfortunately, our rand sentiment indicator is now dropping off quite sharply. It has eventually caught up to reality. The volatility levels within the market are now starting to spike. And so, unfortunately, it tells us that the degree of appreciation that might flow from the rand is not going to be as powerful as at one point we thought it would be. There was a very marked deviation between these two lines this time around. It was for very technical reasons why that happened, related in part to the change of Reg 28, which allowed fund managers to take more and more of their funds abroad, and they did so. The grey listing didn't help. That wasn't factored into the rand sentiment indicator when it happened. Unfortunately, that reality is catching back up, but well, there is still room for the rand to stage a recovery from current levels. So we mustn't lose all hope insofar as that's concerned. Insofar as our carry attractiveness is concerned, we're still doing reasonably well. The reasons why we are doing reasonably well compared to other emerging markets and DMs is quite simply 4 main pillars that have assisted the rand. Those are positive real interest rates that have crept in, to Andre's point. We've had valuations that are still extremely undervalued, terms of trade which have remained positive, and risk-adjusted deposit rates which are at this point in time still rewarding foreigners, or because of the more recent interest rate hikes, dissuading negative speculation against the rand. So as we end off, some of our favorite charts to try and ascertain where value is and can be found in context. These charts were updated yesterday. Against the pound, we're still in very clear exporter value range. We're above that 75 percentile upper limit, which denotes value for exporters. Anything above that, exporters should should consider covering forward. We tend to find that statistically the probability is reasonably high that a year from now, your forward rate for an exporter is going to be substantially higher than the spot rate, so that would be in your favor. This is what it looks like against the pound, against the euro, a similar picture. Again, some value to be found there for exporters, high statistical probability that if you had to cover forward at these levels, that a year from now, your forward rate would be higher than your spot rate. And finally, looking at the dollar, we've made it a little bit easier to understand how this might look like. The tail risk is, of course, the risk of a calamity. That's if the US impose sanctions. That is, if South Africa cozies up to Russia, invites Putin over, hosts him, does not arrest him, becomes friends with the BRICS countries at the expense of the relations that we have with the rest of the Western world. That kind of tail risk would push us to, the likes of 21, 22 to the dollar. That would be a most unwelcome development, but it would push us to an extreme valuation point. The central tendency, and this is what I was alluding to a little bit earlier, the central tendency as reflected in probability theories that we run through our statistics tell us that through the course of time from these levels, barring any of those calamities, the central tendency will be along the green line. In other words, at these sorts of levels, this is a great opportunity for exporters to cover forward because the probability based on historical statistical probabilities, the probability is high that your forward rate is going to be substantially higher than your spot rate. And therein lies the opportunity, I guess, for exporters, importers. Unfortunately, you have to be patient for a while longer and hope that the rand makes a recovery based on, a South African government that does a better job of managing its international relations. So with that, Vichard, I'm happy to hand back to you and take any questions clients might have.
Yes, George. So there's no questions yet on the right-hand side, but I'm going to ask, obviously, if the US goes into recession, when it's a lagging effect on it, the data, obviously. So there's a lot of people that says that the US already started their recession. The data is just not reflecting it at the moment, and as the data comes out, obviously, it will start reflecting. Normally, when the recession hits, obviously, for that period of a patch when it's there, emerging markets tend to underperform. So that's sort of also still a risk that we need to take into account, if I'm correct.
Yes, correct. We absolutely are mindful of the lagged production of data, if you like, but we pay attention to that, and so we are focused. That's why we tend to look at these more forward-looking indicators to give us a sense of how that business cycle might unfold. At this point, the business cycle is looking like it's under strain. There's no question about it. We need to be a little bit patient. Because they did pump in $5 trillion worth of money through COVID, which is an enormous amount. That doesn't just disappear overnight. They're only withdrawing it at the pace of approximately 1 trillion per annum and lifting interest rates. So maybe at a slightly higher pace, but there's no question the cycle will turn. It's just the big debate is when. How long is it going to take before that happens? And that is the more difficult one to answer, but there are definitely indications that the cycle's turning.
Okay, 100%. And then last I've got a question is, if it's asked, what's your view on global trade? More trade in Chinese yuan rather than dollars, and is the world splitting? We've tackled the de-dollarization debate a while ago as well. But just quickly, 1 minute wrap up before we just need to close up this webinar.
Yeah, we got a long way to go. The Chinese yuan, for example, makes up less than 4% of global trade. So yes, it's picked up from the 1% it was at a few years ago, but at the pace that they're going right now, it's going to take us another 2 to 3 decades before there's any kind of parity between trade in the Chinese yuan and the dollar. So I think we need to just park those ideas to one side for now. The dollar's not about to collapse in a heap on the basis of just people moving or countries moving away from the dollar. It might very well happen. I understand the reasons why many of these countries want it to happen. They would like to reduce that global influence that the US and the dollar has on geopolitics, more broadly speaking. But there's a long way to go. And we're nowhere near that point right now. So, I think we're jumping the gun worrying about things like that. We've got far bigger issues to concern ourselves with at the moment.
And then lastly, I'm going to ask Andre just to wrap up for us in a quick 1-minute synopsis of what he sees. And then, we're going to end the session for today.
Yes, thank you. If I listen to what George had said, and I look at some of the graphs, then last year we spoke a lot about the big R, the recession worldwide, and the expectancy, and then the discussions went to lower interest rates and higher interest rates and inflation. And it seemed that one could avoid the recession. I don't think it's quite possible. If I look at the oil price, and if I look at what they do in the East in limiting or cutting crude oil production, yet the oil price is not really going up, then some of these graphs and some of the information throughout the world tells me that we could very well be heading for the big R and that it will materialize. In South Africa, George had spoken about populist policies. I think that's exactly what we're doing, and we're continuously doing it. We could continuously mentioning problems but not really addressing the problems and not really solving it. So we're still heading down the wrong path. The world economies is heading a little bit down the wrong path. They're still speaking up interest rates. So that means that we're still heading for the wall of the big R. So at the moment, things are looking a little bit strange and difficult throughout the world. Yes, it will solve itself over a period of time. And George had said that, that's the difficult one, when. But I think for the moment, the uncertainties, and certainly the uncertainties in South Africa, is at a very, very high level and calls for solid, proper risk management principles where one needs to cover yourself in the short end quite extensively to take some of these extreme volatilities of exchange rates out of your income statement. And I think the emphasis is on how do we survive all this volatility rather than to try and solve any of these problems. It's not within our means to solve it. We have to carefully watch how things develop, but it's our jobs to see how we steer through the volatility. And that would be my summary at this point.
Thank you so much for that. Thanks for Andre. Thanks for George for presenting. Thanks for everybody for tuning in. Have a wonderful day. And if you've got any questions or got anything else, you've got our numbers, please reach out to us, and we'll more than welcome to answer anything offline as well. Enjoy the rest of your day and enjoy the long weekend that comes up, everybody. Cheers.